You saw it too, right? Gold just collapsed. Biggest one-day drop in 5 years. Over 5%, gone. Wiped out weeks of gains in a single Tuesday, and silver took an even bigger hit. Down more than 7%. No war broke out. No major Fed surprise. No global panic, just a quiet, brutal sell-off. And then, silence. Wall Street shrugged. Financial media played it cool. Profit-taking, they said. Normal volatility, they said. Nothing to worry about. This isn't what Wall Street told you. Because here's what really happened, and it changes everything. Before we start, like and subscribe, because there are things here that you need to know before anyone else. Let's rewind. Gold hit a record high just one day before the crash. Over $4,380 an ounce. That's a massive move. Year to date, gold had surged 57%. That's not normal growth. That's vertical. And then boom. From the top straight to full fancy 50. No bounce. No hesitation. Like someone pulled the rug. Meanwhile, silver cratered. Platinum shot up 4.5%. Palladium edged higher. Wait, what? If inflation fears or Fed policy were behind the move, why didn't all metals fall? Exactly. This wasn't about rates. This wasn't about inflation. This was about something else. Let's break down what. They're not telling you. Reuters said it was investors taking profits ahead of the CPI report. MarketWatch blamed a little caution before. Inflation data and a possible rate cut. Cute. But think, why would people dump gold before an inflation report? When inflation is supposed to drive gold higher. And why sell it that hard, that fast, after a 57% run? Because it's not about inflation expectations. It's about what happens when the narrative breaks. Here's what really triggered the sell-off. First, the US CPI report. Delayed, thanks to the government shutdown. No number, no data, just silence. And silence creates uncertainty. When big money can't price risk, they don't wait. They reposition. Then, out of nowhere, Russia announces it's preparing for a possible Trump-Putin summit. You probably didn't even see that headline. Most didn't, but it hit hours before the sell-off began. Add this. Rumors started flying that the US could place tighter export controls on software going to China. Not hardware, software. In other words, the next level of tech warfare. 3 seemingly unrelated stories, but together they formed the perfect storm. No CPI data, a sudden geopolitical wildcard, and a threat to US-China economic stability. For smart money, that's enough. Now picture this. You're managing a multi-billion-dollar fund. You're long gold, way long. You've been riding the trend for months, but now you're staring at a wall of uncertainty. The CPI is delayed. The Fed goes silent. Russia wants a face-to-face, and Washington's about to tighten the screws on Beijing. Again, you don't wait for clarity. You act, so you unwind 10% of your position. Nothing crazy, but your peers are thinking the same thing. And their peers. And leveraged traders. Now ETF flows flip negative. Stop losses trigger. Margin calls fire off. That small unwind becomes an avalanche. And what looks like profit-taking on the surface is actually a liquidity event. This wasn't panic. It was precision. It was smart money saying we're too exposed. Let's rotate out now before the storm hits. But it gets even deeper. Gold didn't just fall. Silver imploded. That's what leverage unwinds look like. Meanwhile, platinum and palladium quietly climbed. Translation, they didn't abandon metals. They rebalanced out of overbought trades, into less crowded ones, out of ETFs, into physical, out of risk on positioning, into safety. This wasn't retreat. This was reallocation. The media won't say that because it doesn't fit the narrative. But you're not here for the narrative. You're here for the truth. Let's go further. You know what else rose during the sell-off? The dollar, not by much, but enough to tell us where the cash was going. Gold drops. Silver drops. Stocks stay flat. The dollar ticks higher. That's capital moving from risk to cash. It's not a vote against metals. It's a vote for liquidity. So what triggered this shift? Not CPI, not rates, not earnings. It was exposure. Everyone was on the same side of the trade. Long gold. Long momentum. Crowded, over-leveraged, over-loved, and when even a whisper of instability shows up, The trade breaks, the story breaks, and the sell-off begins. It's like holding a lit match in a room full of gas. It only takes one spark, and now we're here. Here's what this means for you. First, don't confuse a position unwind with a macro rejection. Gold didn't fall because the bull case is dead. It fell because the trade was too crowded, too fast, and too leveraged. Second, this isn't over. If you think this was just a one-off dip, think again. What we just witnessed was a signal that even safe havens are fragile when the positioning gets extreme, that even the strongest narrative can flip overnight, and that markets today are moving faster than most. Investors can react. If you're late, you're out. So what's next? Watch the dollar. Watch real yields. Watch ETF flows, but more importantly, watch the headlines that don't go viral, because that's where the truth hides. Trump-Putin. That's not random. China export controls. Not a coincidence. Delayed CPI. Not harmless. It's all connected, and the smart money saw it. First, they rotated out. They didn't panic. They didn't bet. They anticipated, and that's the whole game. You want to survive this market? Don't follow headlines. Follow behavior. Follow positioning. Follow pressure, because by the time CNBC explains what happened, it's already too late. We don't chase narratives. We don't bet. We anticipate. So why is the bond market flashing red? Everyone's looking at the Fed. Wall Street is pricing in a 25 basis point cut. FedWatch shows a 95% probability. Practically guaranteed. That's bullish, right? Rate cut means stimulus. Stimulus means asset boost. Asset boost means gold goes up. That's the script. And yet, gold just collapsed 5% overnight. Silver dropped 7%. ETFs bled out fast. This isn't what Wall Street told you, because if the cut is coming, if inflation is easing, if risk is being managed, why does the market feel like it's holding its breath? Reuters says gold fell due to technical correction and Fed expectations. CNBC, markets cautious before inflation data. The story is tidy, simple. The Fed cuts. Gold takes a breather. Everything normal. Move along. But here's the thing. Markets don't crash 5% overnight on technical corrections. Not after a 57% bull run. Not when rate cuts are fully priced in. Not when metals are supposed to be thriving. Something else is moving the pieces. And it's not in DC. It's not in the CPI print. It's not in the Fed minutes. It's offshore. Look east. Japan's central bank has been running yield curve control for years, pinning bond yields near zero. But now that grip is slipping. The Bank of Japan is signaling it's ready to tighten. For real. The yen? All over the place. Traders are repositioning fast, from Tokyo to London to New York. Meanwhile, in China, credit impulse is drying up. Private sector lending is down. Stimulus? Weak. The engine of Chinese growth? Cooling hard. And then there's Russia, not in the headlines, but in the data. Gold reserves? Quietly rotating. Outflows, not massive, but enough to shift the tone. You won't see it in press releases, but you'll see it in the flows, in the sudden selling, in the timing. All of this happening as Wall Street watches the Fed. You see the disconnect. The US is looking inward. Everyone else is repositioning outward. This is how global finance actually works. Think of the Fed, the ECB, the Bank of Japan, and the PBOC like chess players. Each move triggers a response. Not instantly, but inevitably. When the Fed cuts rates, the dollar weakens. That should push gold up, but if the Bank of Japan starts tightening at the same time, then the yen strengthens. Capital flows shift. If the ECB holds firm while the Fed cuts, the euro rises. Dollar demand drops. Foreign holders unwind dollar exposure. That hits US treasuries, hits commodities, hits gold. Now combine that with geopolitical uncertainty, and boom, you've got a market that's not following the script. Suddenly, gold priced in dollars becomes volatile. Not because the fundamentals changed, but because the funding structure changed. Investors aren't selling gold because they hate gold. They're rebalancing exposure, managing risk, rotating currency hedges. It's capital flow mechanics, not sentiment. That's the part most people miss. You think the gold price is about inflation. No, it's about expectations. Policy paths. cross-border flows, funding cost, currency arbitrage. And when those shift, even slightly, leveraged trades unravel fast. Here's what happens. The dollar gets jumpy, volatility spikes. Emerging market flows reverse because carry trades unwind. Funds that borrowed in yen or euro to buy dollar assets, they get margin calls. Gold gets liquidated, not because it's weak, because it's liquid. ETFs bleed. Futures contracts get dumped. Options premiums collapse. And just like that, we get a 5% flush in 24 hours from the outside. Looks like profit-taking. Inside, it's structural. And it started with something no one was watching. The foreign central banks. The global realignment didn't wait for the CPI. It didn't care what the Fed said. It moved when Japan twitched, when China hesitated, when Russia rotated. This is the part where most retail investors get lost. They only track the Fed. They think the US is the driver. It's not. The US is the center of gravity, yes, but capital is global. And in this cycle, the real shifts are happening around the US, not inside it. So let's break it down even simpler. Imagine global capital like a river system. Each central bank controls a dam. Open one, flow increases. Close another, pressure builds elsewhere. Now imagine the Fed opens its gates. But at the same time, Japan starts closing theirs. Europe holds. China slows. Where does the water go? It crashes into the US system with force. It overflows the usual channels. It distorts asset prices. It floods positions no one thought were at risk. Gold is the pressure valve. It absorbs those distortions until it can't. And when the pressure's too much, it breaks. That's what we just saw. And here's where it gets real for you. Most investors, even the pros, are watching the wrong clock. They're waiting for the Fed's next move. But the smart money already moved because the money isn't in reacting. It's in positioning before the shift. They don't care what Powell says next week. They're watching what Kuroda did last week. They're tracking ECB balance sheets, Chinese liquidity injections, Russian gold reserves, and they're positioning accordingly. That's why the crash happened when it did. It wasn't about profit, it wasn't about fear, it was about global pressure, quietly repositioning beneath the surface. So what now? Don't look at gold charts in isolation. Look at dollar strength. Look at TIPS yields. Look at cross-currency swaps. Watch Japan. Watch the euro. Watch China, because the next move won't come from where you're expecting. This isn't about gold. It's about who's holding the bag. When the wind changes, and trust me, the wind is already changing. We don't bet, we anticipate. If you've made it this far, leave a like and subscribe because news like this, you should be the first to know.